A new leader rises in Tokyo. The world looks on, nervous, curious, and uncertain. Japan, the world's third-largest economy, has a new prime minister, Sanae Takaichi. A woman with nationalist convictions, hawkish views on defense, and most notably, a promise to loosen Japan's monetary policy once again. But this isn't just domestic news. Because when Japan opens its monetary floodgates, the ripples don't stop at its shores. They surge through New York, London, Singapore, and every hedge fund spreadsheet that whispers, "Carry trade, welcome to FluxFolio Finance." Today, we're diving deep into how Takaichi's policies could ignite a new era of global liquidity, and why that might be both the fuel for the next boom and the spark of the next bubble. The woman and the mandate. Sanae Takaichi steps into office at one of Japan's most fragile moments. Growth has stagnated below 1% for a decade. Inflation hovers around 2.5%, better than deflation, but dangerously uneven. Public debt is at 263% of GDP, the highest in the developed world. Her predecessor's approval ratings collapsed under rising living costs and a falling yen. Now, Takaichi inherits both the problem and the playbook. Her first signal to markets was clear. Japan must not tighten while the world weakens. That means the Bank of Japan will remain ultra-loose. Rates near zero. Bond buying alive. Liquidity abundant. The yen faucet opens. Think of Japan's monetary system as the world's hidden liquidity pump. For years, Japanese investors borrowed yen at near zero interest, then poured that money abroad into US treasuries, Australian bonds, tech stocks, crypto, even Brazilian real debt. It's called the yen carry trade. When the yen is weak, profits are strong. When Japan prints money, global markets thrive. But when the yen strengthens, those trades implode. With Takaichi's new policy, the faucet reopens. The Bank of Japan has already hinted at buying $6 trillion in bonds per month, keeping yields under 1%. For hedge funds in London or New York, that's a dream. Borrow at 0.1%, invest abroad at 4 to 5%, pocket the spread. Money will gush outward again, chasing yield, chasing risk, chasing the next bubble. The global ripple. When Japan loosens, the world feels it. The last time this happened, in 2020, Japanese funds drove record inflows into US bonds and tech stocks. Gold soared 35%. Crypto tripled. Emerging markets rallied. Now that playbook may return. Takaichi's cabinet is reportedly planning a $15 trillion fiscal stimulus, infrastructure, defense, energy security. Much of it funded by new debt. New yen. New liquidity. Combine that with the global search for returns, and you get a wave of speculative capital unlike anything since Abenomics. But here's the catch. Inflation is back everywhere. And liquidity today doesn't come cheap. The inflation trap. In the US, inflation is still around 3%. In Europe, energy prices are rising again. Even Japan itself, after decades of deflation, is finally seeing prices move. Loosening policy now is like pouring fuel onto a half-contained fire. Cheap yen borrowing doesn't always fund productive investment. It often chases speculative assets. That means more money into US tech and AI stocks. More capital into real estate, pushing prices higher. More bets on crypto and gold as inflation hedges. In short, Takaichi's policy could spark a global asset rally, but one built on borrowed money. And when that carry trade reverses, it can crash hard. The debt and defense dilemma. Here's the contradiction at the heart of Takaichi's plan. She wants fiscal expansion to stimulate growth and defense spending to counter China, while maintaining monetary easing to fund it all. Japan's defense budget is set to hit 2% of GDP by 2027, up from 1% a decade ago, the biggest jump since World War II. Most of that money will go to buying US missiles and aircraft. So Japan prints yen to buy dollars to buy weapons. The US gets the cash. Japan gets the debt. And its people get a weaker currency and higher import prices. It's a channeling economy, a nation that exports capital and imports inflation. The fragile foundation. Behind the headlines, Japan faces deep structural issues no policy can easily fix. Aging population. Nearly 30% of citizens are over 65. Shrinking workforce. The labor pool has fallen by 10 million since the 1990s. Public debt over Y1 quadrillion and rising. Productivity stagnant. Takaichi's stimulus may buy time, but not a solution. If the yen keeps falling and bond yields creep up, Japan could enter a debt spiral where interest payments consume its budget. The carry trade keeps Japan afloat because global investors believe it won't end. But if markets start to fear a reversal, say the Bank of Japan blinks and raises rates, then trillions in borrowed yen positions could unwind overnight. That's not a Japanese risk anymore. That's a global one. The world's reaction. Washington watches closely. A weaker yen means a stronger dollar, and that hurts US exports. Beijing watches too. Japan's military buildup and yen devaluation are both strategic signals. Meanwhile, global investors celebrate. More liquidity, more leverage, more profit. Gold prices tick up, crypto rises, tech stocks hit new highs. It feels like the start of another cycle until it doesn't. Because when Japan eventually tightens, or when markets turn risk off, the carry trade can snap back with violence. It has before, 1998, 2008, 2022, each time, Japan's liquidity reversal triggered a global sell-off. So where does this leave Japan and the world? Takaichi's loose monetary policy may reignite short-term growth and lift global markets. But it also raises three fundamental questions. Can Japan inflate its way to prosperity without eroding its people's purchasing power? Can the world absorb another wave of cheap liquidity without repeating the bubble cycles of the 2010s? And can the yen remain a safe funding currency in a world that's no longer risk-free? Perhaps the answer lies in Takaichi's own words on her first day in office. Japan will no longer wait for the world to recover. We will lead by liquidity. And she might be right. But liquidity has a price. And sooner or later, the bill always arrives. If you found this breakdown insightful, share it with someone who still thinks monetary policy stays inside borders. Like, subscribe, and join us at FluxFolio Finance for more stories where economics meets power. Until next time, stay curious, stay liquid, and stay ahead.